Okay, so we can start today's session. Assalamu alaikum wa rahmatullah. Today we are going to start chapter 8, which is about business and financial analysis. So the learning objective for today's session would be explain the use of hypothesis-driven experimentation, understand different measures for performance, and then understand short survey. Okay, so what is hypothesis-driven analysis? Okay, so using many small experiments with customers in order to refine the product or services. It requires a significant amount of care, experimentation, design, measurement, and refinement. So it's basically research developed. The hypothesis is basically coming from the research domain in which we hypothesized a possible relationship that may happen between independent variable and its relationship with dependent variables. Okay, so there can be different hypotheses we can drive. For example, if we say after sales services, after sales services have a strong positive impact on customer satisfaction. If you're trying to make it from marketing perspective, okay. If from the employees perspective, we can say like rewards. If we give rewards, they have a strong positive correlation with employee satisfaction. Okay, so say we are talking about monetary rewards. How money is going to make employees enhanced, increase in satisfaction. So this is like hypothesis. This is we develop it on the basis of literature, and we might develop hypothesis based on common logic, but then we'll have to conduct experiments and we'll have to check that if it is experimentally proven or not. We can do the surveys and we can find out like our hypotheses were right or wrong. Okay, this is what we were thinking, like if you will increase the monetary rewards, we will see the employee satisfaction will go up. But if you do the experiments, you'll come to know that, or you do the surveys, you'll come to know that this was not true. The employee satisfaction is not increased. Okay, so this kind of process can be called hypothesis-driven analysis. So it is done in small batches. For what we do is crafting up to solution, and then seeing how the customers react to this. Like best reaction or metrics is a purchase decision. And because of the advancement of the technologies, meta advertisement, social media marketing, we can exactly find out which advertisement is giving us the results. Okay, keep the product or services the same for some customers and changing it for other customers. That can also be a part of an experimentation. You can keep the same product for customers A, and you can change the product design for the customer B and see if there is a difference, and then take the results. We're tracking the results and trying to analyze what is happening. It can be done in a retail space, with service operations and manufacturing businesses. So it can give us a real-time data-driven analysis about our business and the products. Okay, why there's an importance of solid financial foundation in an entrepreneurial business. Evaluation, it provides an evaluation of the firm starts with the mission. The key measures should be focused on aspects with which the firm can build its competitive advantages, So if the mission is low cost, the focus would be to control the expenses and measuring the outcome of the regular intervals. So it all depends on the mission statement of the business. Okay, like Khamsa Real, which is like 5 real shop. Let me make the real like this. The focus would be to sell any items equivalent to or less than 5 real. Okay, so their focus is not on the quality. Their focus is on uh, the minimizing the cost, and so that they can provide the affordable products to the customers. Okay, so how we can measure the performance of our business? So analysis should be limited to those areas that are crucial for profit. So we should proceed from general to specific. So basically, we have different kind of analysis techniques in finance, which help us to understand about the business health. So we conduct ratio analysis, we conduct deviation analysis, we conduct sensitivity analysis, and short analysis. Okay, so what is ratio analysis? If you remember, we were talking about the business, or especially entrepreneurship business, the ability to pay the short-term loans. Okay, it can have a series of ratios. If you remember, what is ratio? If 5 is divided by 10, so this might give us a 1:2. Okay, so ratio will get us a understanding about the financial health of the business. So basically, we will be looking for a liquidity ratio, activity ratio, or leverage ratio, and profitability ratios. And the decisions by the managers are done on these ratios. So first one are the liquidity ratio. These ratios that measure the short-term ability of the firm to meet its obligation. Like, what if we have current liabilities? How much we have current assets to meet current liabilities, short-term liabilities. Okay, or then there are different ways in which we see the current assets and how we differentiate them. Financial liquidity is crucial for success. Imagine if a business has got like 1 million of its current liability, or say they have current assets at 1 million, but uh, current liability is 2 million, and its worth is like 100 million. So still they will face problems because they don't have current assets to offset their current liabilities. They can be bank loans, or any accruals that are there that are pressing for you to fulfill with. They can be bank loans, or any accruals that are there that are pressing for you to fulfill within time. This gives us a quick review of difference between one, we call it current liabilities, current ratios. Current ratios, basically current current assets. We know that they are cash, account receivables, cash plus account receivable, or inventory. That is made up of current assets. So current ratios would be current assets divided by current liability. Okay, CA divided by CL. Okay, so if say there is 100 million current assets and we have current liabilities that is equal to 100 million. So that is going to give us a ratio of 1. Okay, is 1 to 1, or it is equivalent to 1, which is in some businesses this is like fine. Imagine if there is a condition like you have 50 million of current assets and you have to pay 100 current loans. So that will be 1:2, or it is 0.5. This is not good. Okay, the more close this figure to 1 is good. A higher than 1, if you consider like if it is 150 to 100, we have 150 current assets and 100 is your current liabilities. So this can be say 1.5, but this means that it's not very good sometimes because you're keeping too much cash with you and you're not converting that cash. See, current assets are cash or account receivable or inventory. So probably you are holding too much inventory or cash receivables. So sometimes it's not considered very good. An ideal condition would be a ratio in which we have current assets are equivalent to current liabilities. So we should not be having so problem. This also depends on the industry in which we are. There is another way to see how quickly we can pay the current liabilities, that we call it quick or asset test. It's like first we will take the current assets and we will take out the inventory out of it, and then we will divide by the current liabilities. So here you see we had the inventory, and now we will take the inventory out of it. So basically cash and account receivables divided by current liabilities. This is going to give us a more sharp view, so we are not majorly dependent on the inventory. You don't know how much inventory you are able to sell and what time the inventory is going to realize into financial cash. So that's why it's crucial. And sometimes we are just looking into cash or cash equivalent, which are account receivables, and we see like what is the ability of the business to offset these liabilities. So what are the issues in ratio analysis? Often the ratio can find are based on Fortune 500 firms. So this is like these are the top firms, so we cannot compare our ratio to well-established firms as we are an entrepreneurial business. So there can be a difference. Then there is little or no relevance to entrepreneurial business because these are fresh businesses, newly emerging budding businesses. Here we are talking about well-established setups. So sometimes ratio does not make a sense. Say for Fortune 500 businesses, the ratio analysis for like say 0.7 is even good. But for our newly established business, probably we would need 2 times current assets, probably because our suppliers are not having a trust on us, and there are other facilities or different kind of expenses that are incurring that were unforeseen. So anyways, entrepreneurial businesses can use the data published by the Risk Management Association, RMA. So this can be more relevant as compared to Fortune 500 ratio analysis data. Online sources of information that new entrepreneurs might find useful can be Margent Online, Factiva, S&P, Net Advantages, on OneSource, Research Insight, and Bizminier. Okay, so what is activity ratio? These are the ratio that measure the efficiency with which an entrepreneur is handling the resources of the business. So we will be looking into inventory turnover, So how soon our inventory is kind of sold, account receivable turnover, and then total or fixed asset turnover. Okay, what are the commonly used ratios for the activity? So inventory turnover, we will be looking for cost of goods sold divided by the inventory. Okay, so that is going to give us, so cost of goods divided by the inventory. It will tell us how much goods are being sold at and how much inventory is being sold. What is the cost? So it might give us a ratio between the cost per inventory. Account receivable turnovers, this is like net credit sales divided by account receivables. So how much we are selling on credit and what are our account receivables ratio, and this can give us a better idea of the account receivable turnover. Okay, then there's a fixed asset turnover. This is like net sales divided by fixed assets. And this is going to give us an idea like how much we are effectively utilizing our assets and what is our overall sales. Then there are certain ratios, we call them leverage ratios, ratios that are used to examine the relative level of indebtedness of the entrepreneurial business. So higher levels of debts are dangerous when the economy turns down. So if you have high loans, so you might have to pay high interest over the loan. So that's why high debts are not very ideal. Then there has to be a debt to equity ratio. So that's why high debts are not very ideal. Then there has to be a debt to equity ratio, then to assets ratio, and time interest on ratio. So these are very crucial ratios that the business analysis we have to look into these. What is debt to equity? It's basically debt meaning the total liability that the business have to pay divided by total assets and then minus total liabilities. So that will going to tell us what is debt to equity ratio. Then we have, let me check it again. I'll have to look into this once again. Okay, debt to equity ratio formula is total liability divided by total shareholders equity. So that will make more sense as compared to this formula, which is a bit confusing. So debt to equity ratio is equal to total liability toward total shareholders equity. It seems like there's a typo here. Okay, debt to asset again is a total liability to total assets. So that is going to give us an idea like what is our debt to asset ratio. Time interest earned is like operating income divided by the interest. So that will going to give us the times that we interest as on profitability ratios. So there's another way to look on the financial health of the company. That is from the profitability perspective. These are the ratios that examine performance of a firm and its ability to make economic rents over the and above its cost. So profitability is the outcome of business's other activities. So there are 5 ratios that are very important. One is gross profit margin, operating profit margin, not net profit margin, return on assets, and return on equity. So what are the commonly used ratios for profitability? We can look into gross profit margin, which is gross profit divided by net sales, operating profit margin, or EBIT, which is called earning before interest and taxes. So this is basically operating income divided by net sales. Net profit margin, which is net profit divided by net sales. Return on assets, or ROA, we call it net profit divided by net assets. Return on equity, ROE, which is net profit divided by equity. Equity is basically total sales assets minus total liabilities. Okay, so imagine why financial dynamics or parameters are important, because they are similar regardless of the type of business in which you are. So even though businesses vary, the core concepts involved a healthy financial endeavors are universal. So what are some of the common similarities and differences between the financials for a bakery versus flower shop? So they both need capital. They both will need equity from the owners. They both might have profit, they might have losses, they might have account receivables, account payable. So all the terminologies that we have discussed in previous slides, they are relevant in both the businesses. Cost of goods sold, net profit, earning before interest and taxes. So all these things are relevant. Inventory, profit, inventory turnover. So these are all relevant. So what is inventory turnover of in the bakery? What is inventory turnover in this flower shop? Okay. So the main concepts are the same, even though the businesses are apparently very different from each other. Okay, what is deviation analysis? It's a chart tracking various performance measures from one time period to another. Like normally after a year, so in 1 year we can make a comparison with another financial year, say financial year 2024 with 2025. So has the additional column one shown the actual change and the showing a percentage change? So we can make another column that can show the change in 2 years. Should be maintained for all the important metrics. So we do this deviation analysis for the important parameters that we'll be looking for. Now, if you recall in the previous slides, we talked about current ratios, we talked about inventory turnover, gross profit margin ratios, net profit margin, number of complaints can be a different criterion that you can use, hours of operations per week. This is like we are using non-financial parameters, number of employees who say we are their first choice. I think these are the ratios we just discussed recently in previous slides. So the deviation analysis, we are just concerned like where were we in 2018 and what is our current state. So imagine our current ratios in 2018 was 1.147 and it has decreased to 1.079. So there has been a decrease of 0.076. The percentage, if you try to see it in percentage, it's 5.76. So is it a bad ratio or is it good? Yes, it's not very bad. As we discussed, any ratio equal to 1 is good because that tells us our current assets have the ability to offset our current liabilities. So it's not bad, to be honest. Okay. So why it has decreased from 1.14 or like 5%? Probably we have learned over the period of time that maintaining this extra cash of like extra assets was not required, so we have uh, used them into another purposes. Inventory turnover was like 1.88. Now it has increased. So inventory turnover, like our inventory is moving fast to the customer. It means like we are operating very good, and that's probably one of the reasons that because of our experience curve, uh, we are getting good sales done. Gross profit margin was little in 2018, and that has increased like 2.99%. That's also a positive sign. Net profit margin has also increased like 13.64 margin. This is also a good sign. Okay. Similarly, we increased like 13.64 margin. This is also a good sign. Okay. Similarly, we have number of complaints have been decreased. This is also a very positive sign. Hours of operations per week, we have increased the working hours. That tells us like why we are so good in selling, why our operations per week has increased. And then number of employees. Yes, we have increased the number of employees. They might also be contributing toward our overall sales. What about the number of employees who say we are their first choice? 117. This is like phenomenal. So it suggests that the company is earning a good repute among the employees, and all whatever the deviation analysis suggests is a positive progress by the company from 2018 to 2019. So all the figures are very encouraging, and let's look at the sensitivity analysis. It's basically a chart using current cash flow statement, income statement, or balance sheets to create a pro forma projections based on some dramatic increase in the sales. Okay, any incident like so there was a weather change and there was snow, or there was some, God forbid, there was a war, or some financial crisis happened, so they can increase sales, they can decrease political. Uh, one president goes and another one comes. One political party wins or they lose, so they can have an impact on our financial. But that can be like for a short time period, so that cannot be for a long time period. Or the complication of a major change in the business, and that will also result in, for example, uh, we have adopted a new machinery, and early our capacity was like say 5,000 units. Because of the new machinery plant, we are getting like 15,000 units produced. So at that time, our sale was say 1.2 million. Now the sale will rise to 3.5 million. Okay, so this rise in sale is subject to this incident that has happened. So we will have to take into account this phenomenon as well. Okay, how we can use this short survey in businesses? So short surveys gather contextual information that is subject to the interpretation. So we can get the data and we can try to understand the purpose of it. Surveys can be given. Surveys are like short questions that we give to our staff or competitors, and we can get the information about any phenomena. So surveys can be given to anyone transactions with the businesses. There are some bias involved in the service. So every method of research can have some bias. So questions should be related directly to the mission strategy of the company. So we need to understand, like, if we are trying to understand the right phenomena, or we are, what is that we are trying to examine, it has to be clearly linked with the survey. This is an example of questions we can take for the survey, like how do you rate the prices? Lower than the most, same, or higher than the most? So this survey, if the option is our customers choose it like our prices are higher than the most. Okay, is the quality of our product lower than the most, same, or higher than the most? Or if the feedback is lower than the most, the nature of our services is lower than the most, higher than the most, it's like same. Okay, so based on this survey, what do you think? What consideration we should be taking into account? So our prices are higher, and our quality is not considered higher. So there are, and the nature of services is same like others. So this can result into a very critical review of the pricing strategy, and we'll have to look into the product quality. So this survey gives us some food for thought. Imagine the reply would have been like, how is your price related? If the price was like higher than the others, and if they consider like our product's quality is superior and their services are also good. So if the higher price is also resulting us into higher quality and superior services, that would have been given us a great advantage. But in this case, we don't have the great advantage. So there is a serious consideration that we need to either decrease the price or to improve the quality of the product. Okay, survey data, they can be tabulated and examined with some simple statistics such as percentages. With slightly more sophisticated analysis techniques, much more can be learned. Like example, cross-tabulation and simple regulation. So you can conduct a regression and you can learn the pattern, like how these independent variable is affecting the dependent variable. Why it's important to have a measurement focus? Standard and potential advantages are two aspects of the business. Standard means parts of the business that must be done just to be considered a part of a particular industry. Potential advantages, areas where the business really tries to differentiate. So the business has to differentiate and work on the standard and potential advantages. Like McDonald's. Basically, they are in the restaurant business, but they just become not just an ordinary kind of a restaurant, they become QSR, which is like quick serving restaurant, and they can become a brand name for quick service restaurant, or we call it become a brand name for quick service restaurant, or we call it fast foods. So focus should on areas providing competitive advantage. Concentrating the analysis efforts on those areas that are unique. Put the founders focus on those areas that can create a differentiation for the businesses compared to those of the competitor. So if you work on your differentiation, you make your product different than others. You can develop unique selling proposition. We call it USP. and then that can lead you to be a winner in the market. Okay, today's lesson from famous entrepreneur, we have Ritesh Agarwal. Ritesh Agarwal is the founder for OYO Rooms, which is India's largest hospitality company, founded in 2013. So the lesson is start small, nail it, and then make it big. So if there's only one lesson we can learn from Ritesh Agarwal, is that find the right mentor. Okay, these are the questions that should be resolved in your head by now, and you should have a better understanding about them. What is the hypothesis-driven experimentation? What are the means to evaluate a firm's its activities and its performance? You can talk about the ratios that we have discussed. How a firm can design a simple survey, and you have a good idea like the kind of survey we just discussed. That was the simplest of its form. Okay, folks, we are at the end of today's lecture. This is the reference book we are following. And thank you very much. If you have any questions, you are welcome to ask.